We can't read Vladimir Putin's head. So as a portfolio manager, how do you play this?
Well, I think clearly it's a significant risk, and it's one where the uncertainty is elevated, not just on whether there'll actually be an invasion, but what the Western response to that would be, and then the impact on energy prices. But with energy prices already so high and that squeezing real wages, further shocks, I think, do pose a risk. So I think, to me, it makes sense to be dialing back one's risk positions a bit, not overreacting, but just moderating the size of risk positions and getting a bit closer to neutral than one would otherwise be.
Mike, what happens if there's not an invasion, but actually, consumers almost like go into a frenzy of thinking that there's inflation, which will feed to I don't know if it's automatic, but will feed to higher inflation. Like, how do you protect yourself against that?
Yeah, I mean, I think they're different risks, because if you have the real wage squeeze, that's going to weigh on people's ability to spend on other non-energy goods. And then eventually that would moderate the inflation pressure and have different implications. Whereas if it starts to feed through into a wage price spiral, which is what everyone's really concerned about, that's obviously the worst case scenario, where you get high inflation and you've got this hit from energy prices. That's really quite difficult to hedge, other than with something like put options or derivatives to try and hedge some of that risk out, because I think it would weigh on some of the higher valued stocks at the same time as weighing on risk assets more broadly. So I think, looking out there at the moment, probably just makes sense to dial that risk back a little bit and have less of an overweight than one would have had if this was not the case.
Mike, give me a sense of how you play this. How do you, what happens, for example, to bond yields in this environment? What do you buy into?
Yeah, it's very hard to say, frankly. I mean, with bond yields, obviously higher inflation, all else equal, you would think if you get that wage price spiral, then it leads to central banks putting rates up further. But I do think the risk for those higher oil prices is that it's going to weigh on growth, because it's essentially a tax on the consumer. And so if anything, when I look at the pricing that's currently baked in for this year for bond prices, it seems to me like it's more likely that rates go up a little bit slower than is currently being priced. I think eventually rates are going to rise further than is being priced, unless this ends up causing a significant hit to growth.
Mike, there's something that really caught my eye, and actually I don't know how you model this, and it's extremely difficult. So I know it's like, for you it's probably a nightmare day to call on Bloomberg TV to try and explain how you look at this, but Bloomberg Economics has something called a shock model, CHOK, and basically they say that a climb in crude to $100 a barrel from, $70 at the end of 2021 translates into inflation going higher by about half a percentage point in the US and Europe in the second half of the year. I mean, that's huge for central banks.
Yeah, I guess it comes down to how persistent it is, which is, what we've been talking about for over a year now. But it comes down to me to the fact that you can't avoid this, right? Obviously, in the long run, it'd be great for people to be able to switch away from fossil fuels. But at the moment, people don't have that option in a very sort of quick way. And therefore, it is going to reduce the amount that people have to spend on other things. Now, particularly in the US, they've still got pretty elevated savings. Our data suggests that household deposits are still about 80% higher than they were pre-pandemic. So it's probably not going to cause a recession, but it does mean that they've got less money to spend on fun stuff than they otherwise would do. And so that could actually end up dampening core inflation, even though it obviously puts higher near-term pressure on headline inflation. But it is very hard to read.